So the market has had a pretty steep decline over the past few weeks, and a lot of people are panicking. I've got a lot of people that have reached out to me, emailed me saying, their positions are deep in the money, losing a lot of money. Many of them have got their positions assigned, and quite a number of them actually have gotten a margin call. So they're asking me, Davis, help, what can I do during these times? How can we trade this kind of market? So during these times where a lot of people are panicking, I'm actually feeling pretty comfortable. And the reason is because I've already got positions that I put ahead of time before this big move down to actually want to capitalize and to capture such big moves down. So I've already got positions in place where I want the market to come down for it to be inside the max profit zone, which I already have quite a number at the moment. So in this video, I'm going to be sharing with you a strategy that is a high probability one that you can also place on the cash settled index options like SPX or the mini SPX, where you can hold all the way to expiration. And also you do not have to worry about early assignment or even assignment of shares, which means to say if you don't get assigned shares, then the chances of you getting margin call is not that high. And at the same time, you are looking for such a big moves down like this so that you can actually get into the max profit zone. So what is this option strategy? So let me head on over to the option chain to show you this. So over here, as you can see, I have put up the XSP, which is the mini SPX. So for the most part, I would actually suggest beginners to start off with the mini SPX first before going to the SPX. And the reason is that the SPX is a much bigger product and you can lose much more if you don't know what you're doing. So if you have a much bigger account, I would say something like 6 figures and above, then you can consider the SPX. But if you're just starting out, then I would say start out with the XSP first, because the SPX is the same as the XSP, it's just that it's a much bigger product, I think about 10 times bigger. So with the XSP, you're able to position size much better, especially if you have a smaller account. So what is this strategy? So this strategy basically involves two very simple strategies. So let me just first off start off with the DTE selection. So a lot of people have asked before, Davis, can I put on the strategy on the lower DTEs, like maybe the 7 DTE or 1 DTE or 0 DTE in fact? And the answer is yes, if you want to, but the problem is that you may not have the edge when you're trading such short-term DTEs, because according to the Tasty Trade studies and also based on the results that I've seen for myself, when you go for the DTEs around 45, this is where you have the edge. The edge is whereby the realized move is more often the time smaller than the expected move. So what that just means is that in the long term, you actually have a higher win rate than what the theoretical suggests. So if you want this edge on your side, then you want to go to somewhere around 45 DTEs. But if you don't want this edge, you want to rely, on your own skills, then you can definitely go for the lower DTE, but that'll be on you. So for this, I'm going to open up the 45 DTE. So like I mentioned, this strategy just involves two very simple strategies. You just have number one, the bull put spread plus the bear put spread. So it's a put credit spread that is financing the put debit spread. So how do we make this a high probability strategy first of all? So when we talk about high probability strategies, then in this case, let's just say we are looking at something that is 80%. So if you want something that is 80%, what will give us an indication whether this is going to be 80% win rate or not? It comes down to the delta that you chose on the short put side, right? So this will be a strategy whereby it's going to be based off the short put selection. So as you can see over here, if I was to go for the 20 delta one and I was to just to click on 524, you will see that the pop should be somewhere around 80%. So let me just move my handsome face to the right hand side. Okay, that's debatable. But over here, you can see over here, the pop is 82%. So when you go for around 20 deltas, it just means that there is roughly about a 20% chance that the market will be below 524 at expiration. And because this is the cash settled index options, right, XSP or mini SPX, SPX, then you can actually hold all the way to expiration without worrying about any early assignment or assignment of shares. So it will just be settled in cash, any P&L. So over here, when I choose the 524 based on 20 deltas, you can see that the pop is 82%. If I was to go all the way to, let's say, 533, then it should be somewhere around 75%, as you can see, somewhere around there. So let me just go somewhere to 524. So next we want to choose the long put. So for this, I'm just going to choose roughly around 515. So this is where you adjust it depending on your risk. If you have a $500 risk, then you want to adjust it maybe smaller, maybe somewhere around here, right? As you can see, this is 344. If you shift this to 515, 785. So somewhere around here. So maybe let me just make it a round number, right? 525 and 515. So this way, 10-point wide, roughly max loss of 869. So you notice that the pop have been shifted a little bit below 80%, but that's fine because we know that if you have the DTE that is somewhere around 45 and above, then this is where you have the edge. So the edge just again translate to your win rate. Your win rate, actual win rate, is going to be higher than what the theory suggests. So the theory suggests 78%, but in reality, because we have this edge using this 45 DT and above, you're going to realize you're going to have a slightly higher win rate. So next, this is where we go to the put debit spread. So the put debit spread, very simply, we can just start off by going to the at the money options. So over here, this is where the at the money is, 561. I'm just going to click 561 and maybe just click 559 and see what we get. So as you can see over here, now we actually have a put debit spread with this put credit spread. So what it gives us is a structure where we want the market to actually go down. So you can see over here, this is our max profit and this is our max loss. Now, how can we skew this into our favor where we have a pretty favorable risk to reward ratio? Well, all you got to do is simply just expand this put debit spread width. So you are going to forego some of the upfront credit, but you're going to get a nicer risk to reward ratio. Let's see, if I was to shift this to 558, you can see now my max profit increased to 324, and now my max loss is 676. And let me try one more strike. What can we push to? As you can see over here, we can even push to 391, 609, but now we actually have a debit up front. So what this means is that if the market actually goes above this put debit spread at expiration, then we're going to lose this amount. So it's not that much, but ideally, I would like to have one where there's no risk to the upside, because in case I'm wrong, in case the market actually goes down and goes back up, or just goes straight up from here, if I have no risk to the upside, that means this is a credit, then I'm still going to be in a profit. So remember, we are trading this on the S&P 500. So XSP is the S&P 500. So in the long term, the market just wants to go up. So this is what you call a positive drift vehicle. So that is why I want to construct it with this put credit spread down here in the event whereby if the market actually goes up, I'm still at least going to be in a profit. So in this case, I'm going to have to adjust this. So how can I adjust this? I can just shift this back to making it 22 cents credit up front. So now we have no risk to the upside. Now, based on this structure down here, this is actually pretty versatile because we can actually skew this to our favor even more. So let's say, for example, you want a higher risk to reward ratio. So what you can do is, instead of stretching it to this point wide at here, what you could do is you can shift it further out of the money. Because when you shift it further out of the money like this, now you can see that we have a nice risk to reward ratio, and we can slightly adjust this until we get a credit. So let me just shift it further out of the money even again. Maybe now I go to 554. And you can see now we have an upfront credit, and you can see we almost have a 1:1 reward. So when you do it this way, the structure you have now is whereby you actually want the market to go down. So this is where the current market price is. We want the market to actually go down for it to go inside the max profit zone. And this is where we can get this max profit. And in the event, let's say we are wrong and the market actually goes all the way down, then you don't actually lose that much based on this construct, because you can see that the max loss is not that big compared to the max profit. So you actually have a pretty favorable risk to reward ratio with this structure over here. So as you can see, very versatile. And that is why I'm actually looking forward to the market going down, because I already have positions in place in my portfolio to actually capture any moves down into the max profit zone. So with these structures down here, you actually look for a move down. So that is why, like I mentioned earlier, I'm not panicking. In fact, I feel very comfortable because I have quite a number of these structures that I have over here. So let me just very quickly show you. Let me just go out. Let me just remove all these drawings. And you can see over here, I have positions over here. And you can see the next one is at 10 DTE, which is going to expire soon. And you can see my put credit spread is at 540. It's at 540. Market currently is at around 560, and it's nicely inside my profit zone, this max profit zone. You can see my debit spread is somewhere around here. So anywhere in between these two short put strikes, this 597 and 540 at expiration, I'm going to be in the max profit. So how does this actually look like on the chart? Let me just very quickly show it to you. So let me go back to the DTE which we had on. So our strikes down here is 525, 515, and then 554, 550. So I'm going to go back to the chart down here, and I'm going to construct it on the chart. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So let me go to the put credit spread side first. Let me just draw a line down here, 525. Let me just adjust this to exactly 525. And then I'm going to lock it so that it stays in place. And then I'm going to clone this so that I have one as well at 515. So this will denote where our long put is. So this is our put credit spread side. Now, what about our put debit side? So let's take a look at our put debit spread again. It's 554 and 550. So let me just clone this as well. Let me just duplicate and put this at 554. Okay, and then let me clone this as well. Change this to 550. And as you can see, where our max profit zone is down here between our short put strikes. So we actually want the market to go down in order for us to realize this max profit of 412 at expiration. So you can see the psychology you're going to have once you put on this strategy. Most of the time when people put on their strategy, it's mostly bullish. Let's say just the put credit spread. Now, nothing wrong with the put credit spread, but you can also put on other strategies at the same time. So if you just have the put credit spread all the time, you're just cursing and swearing at the market, hoping the market goes back up. But if it doesn't go back up, then you're going to be in a loss, which does happen for a put credit spread, of course. But if you have this strategy on, you actually want the market to go down. So this way, if the market comes down, you have a chance to be in this max profit zone. Now, at this point, you might be asking this question, Davis, why do I want to put on this put debit spread down here? Why don't I just make things simple and just have this put credit spread and hold all the way to expiration? And the answer is you can, but it's just that it's just a different trade, right? It's a different strategy. You can see this. If I was to remove this put debit spread down here, let me remove the leg here, remove the leg here. You can see what happens to your max profit. Your max profit now drops to 135. Previously, it was about 400 plus, and your max loss have now gone up to 865. So now you don't have that good of a risk to reward ratio compared to the strategy I showed you just now. So if you want to put this on, yes, you can, but it's just that this is not that bearish of a strategy compared to just now. Because just now, if the market was to go down, you actually look forward to it. But when you put on this put credit spread by itself, then this is where, like I mentioned earlier, you're going to be cursing and swearing. And this is where a lot of people send me a lot of emails where they're saying they're in trouble. So if you want to have a position whereby you look forward to the market going down, then this is where you want to implement this put debit spread as well. And this is where you actually want the market to go down in order to actually get a much bigger profit. So as you can see, 406. Now, you might be also asking, but Davis, in that case, why don't I just put on the put debit spread by itself? Why do I want to put this put credit spread? Because if I remove this put credit spread down here, and if the market really crashes and go all the way past to 510 even at expiration, then this trade is still going to be in a profit because there's no put credit spread for me to take loss on the downside. So why don't I just put the put debit spread by itself? And the answer again, yes, you can put the put debit spread if you're right on the view whereby the market goes down and doesn't go up. But what if you put on the trade and all of a sudden the market goes up? And then now you're going to be in a loss. If you're going to put on a put credit spread to finance this trade, then at least if the market goes up, you're at least still going to be in a profit. So this is where the trade-off really happens. And for me personally, I like to put on the one with the put credit spread together with the put debit spread, because ultimately this is on the S&P 500. So what do I mean by that? S&P 500 is a positive drift vehicle, which means to say over the long term, the market just wants to go up. So if the market wants to go up over the long term, and you take a look at the statistics, it actually goes up more often than it actually goes down, which means to say more often than not, if you put on the debit spread, it's going to end up as a net loss. So if you're going to put this on positive drift vehicle like this, then putting on the put debit spread by itself continuously over the long term, it's going to be a losing proposition, unless of course you can correctly time it and just only capture at certain times when the market goes down. So this again comes down to your timing the market. So for me, I'm not that good at timing the market. I just want to play the statistics. I want to be mechanical over the long term. So this is where I use this put credit spread as well, add that in, and then I am able to not worry if the market goes up. So you might be wondering, Davis, what if the market actually goes down and you have the max loss? And guess what? It happens. It happens. You will get the max loss. You just have to understand that over the long term, even though you have the max loss, you're still going to be net profitable. You can see here already, it says 80% of the time you're going to be profitable, which means 20% of the time you will lose money. So you can also just put this on. It's possible you can have losses, but take it in your stride, because over time it will be net profitable. Now, the next question you might be asking, Davis, I like all this, but can we implement a stop loss for this strategy? Because if I was to put the stop loss, at least I don't lose that much. I can lose less than whatever this max loss is suggesting down here. So maybe if the market goes down to around 522, I'm going to put a stop loss and I'm going to just cut off the trade. So a stop loss down here, or maybe a stop loss based on a certain multiple of the profit or the premium, so to speak. So the one thing about stop losses on options is that the Tasty Trade has already done extensive studies to show us that stop loss is not that effective on options. If you can see over here, you can see that this is a study done by the Tasty Trade team where they show on spreads. If you were to have a 2x stop loss, that means based on the premium that you receive, you actually have a worse performance compared to if you hold all the way to expiration. Now, you might be saying, oh, but Davis, my stop loss is not 2x, it's 3x or 4x or 5x the premium. Well, the Tasty Trade team also have already anticipated you would ask that, and they already have all these studies done for you. As you can see over here, regardless what multiple of the losses that you have, the stop loss, it's still going to pale in comparison to the results that you get when you hold all the way to expiration. And you can see this study is done over a decade. As you can see, it's from 2007, even before that, all the way to 2015 and beyond. Now, at this point, people will say this and say, but Davis, my stop loss is not based on this. My stop loss is based on technical analysis. Do you think that will work? Or my stop loss is based on something else, right? Maybe the stars or the moon, or whenever my wife comes and scold me, I will consider this a stop loss. So if you have a different implementation of stop loss, then I can only say that the only objective way to know whether it's going to be better than holding to expiration is if you actually test it out, if you actually trade it out over a decent sample size, maybe over 100 trades and more, and you compare them side by side. That means one side you trade all the way to expiration, hold it to expiration, and the other side you trade according to your rules of exit. So if you were to compare this over 100 trades and more, you can have an objective view to see which one actually does better. And if yours actually does better, then by all means, definitely go ahead to do that and let me know your results as well, because then we can go to Tasty Trade and say, hey guys, you are wrong on your studies because your way of using the stop loss actually works. But until then, if you're not sure, then just by all means go with the studies that the Tasty Trade have done, because all these studies have already gone past quite a number of years to show that over the long term, holding to expiration does better than having a stop loss. And there's one added benefit of having a spread using the long put as your stop loss rather than have an actual hard stop loss. And that is if the market actually goes down, you do not get stopped out immediately. If you were to put a stop loss, let's say down here, you get stopped out immediately. Yes, you lose a little bit lesser than if the market lands down here at expiration. But if the market actually recovers, then you would have actually taken a loss when this spread itself would have been in a profit. So if you put a stop loss down here, you would have already quickly exited the trade, whereby if you had this spread on, the market can go all the way to 490, but there's still time for the trade to recover. Maybe by the time it goes to 490, there's still 30 days left in the trade. You can make full use of the 30 days. Eventually, the market could recover, because remember, we are on a positive drift vehicle. So if the market does actually recover by expiration, then you would have been in a profit on this trade. But if you put a stop loss, you would have already been stopped out. So if your stop loss is, let's say, for example, you don't want to lose more than $600, and that's where you put your stop loss, then this is where you should actually put your long put at. So your long put should be the one that decides how much risk you take on the trade. So if, let's say, you don't want to lose more than $500, then you should adjust this so that you don't lose more than $500. So maybe if over here, I just have to shift one strike down, and now you can see my max loss is 506, and I can hold all the way to expiration. So that's my take about stop loss. But again, in the end, if you want to implement it, you think it's going to give you a better result, then by all means, go ahead and implement it. But always be objective rather than just rely on what you think, because at the end, if you have statistics is going to tell you objectively which is better for you in the long term. So hopefully you found this video helpful, and if you have, I would greatly appreciate if you give me a thumbs up on this video, and also subscribe to my channel for more videos like this, and I'll see you in the next video.